Hey traders, it's Friday. And because it's Friday, I have Mr. Jim Welsh from Macro Tides with us. So I'm so happy to bring him in because today's response to the jobs report is exactly what you said last weekend or
Yep.
last week. You said the labor market should be our focus. It's the
Yep.
FOMCs. And how do you read the data that we got today, Jim?
Well, again, last week when we talked, I discussed indicators that are more focused on where will the labor market be 6 months from now. All right. And I still think that's important because at inflection points, the data stays pretty healthy, obviously, before it either turns down, or if you're in a recession, turns up, and so forth. So today's number was a good number, obviously. The street was looking for 200,000. It came in at 300,000. Labor participation improved. Hours worked ticked up by 1/10. Year-over-year earnings, as the Labor Department measures it, I think eased from 4.1 to 4. So across the board, it was a good number. And the response by the markets, Treasury yields ticked higher. Because again, they're looking at, well, what does that really mean for monetary policy? The equity market's a little bit more bifurcated in the sense of, well, we can deal with higher interest rates as long as the economy is in good shape. And I think for me, what it underscores, Blake, if and when we see a slowdown in the economy, the market is going to be vulnerable because right now it's hanging its hat on the economy staying good, don't have to worry about a recession. And that's why the market's, in a sense, able to overcome the idea, okay, rates may not come down as much. Oh, rates are actually ticking up in terms of Treasury yields. But the more important thing is the economy's in good shape. Corporate earnings are going to continue to grow.
So, well, you kind of said that and you laughed as you said it. So why did you laugh that, about the economy? Because the economy seems strong. It doesn't feel
It's
like
in
it's going
good
to slow
shape
down.
at this
Yeah.
point.
Yeah.
Again, I continue to feel that as we get to mid-year in the second half of this year, various labor market indicators suggest that job growth is going to slow somewhat materially. And I think that will introduce a big negative for the equity market. Now, the caveat here is you could get a blow off top if, in other words, oh my God, the economy's weakening. So you get a little bit of a correction. And then it's like, yeah, but that's going to get the Fed to cut rates. And then the Fed actually does cut rates. And you could get them move up to 5,500 to 6,000 on the S&P. I still believe that the initial response to a slowdown in the economy will be about selling. Does it take it down 7% or 10% or something more? No way of knowing. The underlying technicals of the market, the advanced decline line, which we've talked from time to time about, has been making higher highs. So historically, prior to significant declines, like in 2022, in January, the S&P made a new high, and the 80 line did not confirm it. Same thing happened in 2007. So that's what I'm waiting for, to see those kinds of momentum divergences to signal that a much larger decline is likely. In the near term, I still think if I'm right about next week's CPI report, and we're going to talk about that in a second, I think that's going to cause Treasury yields to go up, and I think the stock market reacts negatively to that. So I still think before you get a big blow off, there would be a decline of some magnitude before the Fed would come to the rescue and indicate that it's going to be cutting rates.
Okay. So, okay, let me ask this question. I was just thinking about how I wanted to frame this.
Yeah.
So you think that inflation is going to matter? I mean, obviously jobs mattered. You think that inflation is
Yeah.
going to matter. But I'm going to play devil's advocate.
Sure.
Again, we have gone, and obviously I think what you're insinuating is if inflation goes higher, the market's going to have a negative response because people are going to feel that the Fed won't cut rates then
Right.
again. But the market hasn't cared as we've gone from expecting 6 rate cuts to 3, if we go to 2, if we go to
Yeah. Is that
1,
going to matter?
is
Yeah.
it really? I mean, stocks continue to grind higher. Does the market really care? Again, this is devil's advocate. So,
Yeah,
what do you
yeah, yeah,
think?
yeah. That is a distinct possibility. And again, the market is hanging its hat on economic growth. And if that story remains intact, for the balance of 2024, it pretty much, I think, would preclude anything. I don't think you see a 10% or greater decline. I think the inflection point in the economy is what would hurt the stock market more than the prospect that we're not getting rate cuts, because they can offset that. Oh, we're not getting rate cuts, but it's for a good reason. All of a sudden, if that good reason diminishes, then you're in that window of time where, gee, the economy's slowing, and yet the Fed isn't going to cut right away, which is a possibility if the inflation numbers don't really trend lower in a meaningful way. And what I've been writing about the last few weeks is, if you look at the numbers going out the second half of this year, the takeaway values are smaller in the second half of 2023 than the first half of 2023. And so on the core PCE, they were 35 basis points in the first half of 2023. It drops to 15. So what that means, Blake, is the core PCE is going to have to rise no more than 15 basis points month after month after month. Otherwise, the core rate is going to go up. And the same thing is going to happen to headline CPI and the rest of them. So the table is set that unless you see real additional progress in inflation coming down, we're going to see in the inflation metrics go sideways to trending up, not in a big way, meaningful way, but from the Fed's perspective, they want confidence that they can cut rates. And the idea of adding stimulus, if inflation's flatlining comfortably above 2%, there's no incentive for them to do that, because the risk is, okay, we're going to add some gasoline to the fire, and inflation will then pick up next year. So that, to me, is the conundrum that the Fed is facing, and then the markets, because if the data doesn't come in friendly, the markets have to adjust to, wait a second, the Fed isn't going to be cutting rates as much as we expected.
Yeah.
And the tension, the main thing is, if the inflation number holds steady to creeps up a little bit, the first sign of slowing in the economy, I don't think the Fed's going to rush to cut rates. And that's the window where the market could be vulnerable to a pullback of some magnitude. And then again, I think there's the potential for a blow off. Once the economy slows enough, you've gotten a sell off. Oh my God, the Fed's coming to the rescue. And then you could see them move to 6,000. So I think that we're going to see a fair amount of volatility over the next 6 to 12 months, because I'm right about the economy approaching an inflection point. Things are going to change, and change quickly.
Well, we talk about this, and you go, when that happens, or theoretically, I mean, the S&P could be at 5,500 before the market starts to feel, holy cow, maybe growth is going to start to slow, or maybe inflation, maybe we're not going to get that rate cut, maybe we get a hike. Maybe that's what turns the market. I don't know.
Well, that would definitely, if the inflation ramped higher than even I'm expecting, and people are like, whoa, wait a second, forget about cuts. We're maybe talking about a hike. Honestly, I don't think inflation is going to make that a real possibility. I just think in the near term, yesterday's sell-off was, I think, two factors: oil prices ramping higher, and then Kashkari, the Minneapolis Fed president, kind of saying, hey, maybe we're not going to get any. So you had a reason why the market was starting to back off. And then, Kashkari's comments, I think, gave a push.
Yeah.
So I think the market would be vulnerable to it. Again, is it a 5%? Is it 7%? Some kind of a correction if we get negative inflation news, which I'm confident we are going to get next Wednesday. Then it's just, okay, we'll see what kind of weakness and selling pressure materializes.
Well,
So
let's
look at the labor market.
Yeah, let's talk about the labor market and talk some of your charts that you brought. And the first chart you brought here was about household surveys. So can you explain what we're looking at?
Yeah, we talked about this last week. So if somebody wants to kind of take a deeper dive, they should listen to last week's conversation. And then I ended up with, I forgot to put the chart that shows a longer term picture of the establishment versus household survey. You know, I went through a fairly lengthy explanation last week in terms of historically, the household survey starts to weaken before the establishment. And the dynamic that causes that is that employers not wanting to let people go, and in the meantime, they're cutting back hours. So all of a sudden, I'm a temporary worker. I used to be getting 28 hours. Now I'm only getting 15 to 20. What do? I go out and find another part-time job. So in the establishment survey, it counts a person with 2 part-time jobs as 2 jobs. The household survey doesn't. So this just shows what we've seen, I think, in the last, since February of last year, like 900,000, this is before today's number, gain in the establishment survey, and the household survey is down 250,000. So it's like a gap of like 1.2, 1.3 million. And then if we go to the next chart, it kind of focuses, because what I was talking about last week was prior to the 2000 recession, 2007 recession, the same thing happened. And this does a chart that I think makes that, illustrates that more clearly. So if you look, the full-time employment, which is what we're seeing is a decline in full-time employment and a big increase in part-time employment in the establishment survey. You can see prior to the 2001 recession, 2007, you can see as it was weakening, and then obviously plunged during 2008 because things got pretty ugly. The 2020, to me, we have to kind of ignore that just because that was not a normal business cycle.
Right.
But what we can see is we now see full-time employment is negative. So, and part-time employment is up. So to me, the establishment survey, because it's counting in some cases double counting part-time jobs, is not a sign of strength. When you get to this stage of the business cycle, it's more of a sign of coming weakness. So again, these charts, as I said last week, I'm not looking, I didn't think the number this week would be, or this for March would be weak on the job number, but we're seeing a continuation. So the establishment survey, Blake, had 300,000 jobs. The household survey was 170. 170 is an okay number, but this gap continues to widen. So
Jim, I just say I've got, just knowing a lot of people in the workforce and in a pretty economically sensitive place where I live, with pretty robust metro area. I've heard from a lot of people different situations where people lose their job and they have to pick up 2 jobs to kind of make up what they had lost, because they're having a hard time finding that
the one full-time job that's going to pay the bills.
Right, exactly. Yeah, it's interesting. And so we're seeing that on a much broader level, I guess, is what you're pointing out. So
and again, this is like, where will the labor market be 6 months from now? I don't think it's going to be anywhere near as strong based on the historical pattern that we've seen going back a good chunk of time. The next chart also looks at the changes in full-time employment. So it's just focusing on full-time employment, and it's inverse in the sense that as jobs are being lost, this is inverted to show an uptick. And what you can see, again, prior to the 2001 recession, 2008 recession, full-time employment started to creep, full-time job losses started to creep higher. And, the rate of ascent is obviously very gradual at this point in time. But nonetheless, you can see that if you slapped some kind of a moving average on this 3-month moving average, I would, like a 12-month exponential or something. My guess is we probably have crossed above that 12-month exponential.
Yeah,
So,
basing.
so again, I just think that we're at an inflection point. At an inflection point, some weird things start to happen to the data that's underneath the job number as reported in the establishment survey. And most people are just solely looking at the establishment survey. And for me, looking at this stuff, again, suggests that 6 months from now, the labor market's going to be weaker and maybe considerably weaker than it is right now. So check back in September.
Right.
We'll review all this stuff, I'm sure, somewhere along the line.
We will. And next week, we've got CPI. You said it is going to be important. So explain to us what you're looking at here.
Okay. Again, the rates have changed. So CPI, all the inflation numbers are 12-month rate of change. So you take out the number from 12 months ago and you add the current month in. So what you can see in March, the headline from 2023, we're going to subtract 8 basis points. Now, the last 2 months, the headline CPI has been up 31 and 44. So let's say it's up 40 bips. The year over year was 315. They rounded it to 320. So my point is, I think the headline will go from 320 to 340. And potentially, based on rounding, it could go 350. Well, even a 0.2 of an increase on a month is going to, I think, freak people out. And we're seeing oil prices, gasoline prices keep ticking higher. There will be some things, maybe used cars will subtract a little bit and so forth. But my point is, a jump of 0.2%, I think, is attention grabbing and headline grabbing. The core may just hold steady. Why? Because it was 32 basis points in March of last year. And if, the last 2 months have been a little bit higher, but let's say it comes in at 32, it'll trend at 375. So it either tick down to 3.7 from 3.8 or stay at 3.8 based on rounding. Most people pay attention to the headline. So here we have, I think markets are a little bit more skittish regarding inflation. And this number, I think, has the potential to kind of shake things up a little bit because it's obviously flying contrary to the Fed getting confidence. So next Wednesday, I think, is going to be a key. If this number happens and nobody cares, it's like, okay, maybe the trends are just so entrenched it doesn't matter. I don't think so. When we look at some of the charts, to me, especially Treasury yields, which I think is I think we're talking dollar first. Okay. Sorry.
Well, let's talk about the dollar. Okay.
Yeah.
And by the way, the dollar's been messy, very messy.
Yeah. Well, you saw the dip. Okay. Over the last 2 weeks, the expectation was it's going to trade above 104.97, which it did by a modest amount. Then the ISM services survey came out, and it was softer than expected. Dollar immediately pulled back. So we can see how sensitive, currencies are and dollar is in terms of what's happening with the economy in the outlook for rate cuts. The jobs report came in better than expected. The dollar immediately rebounded. To me, just looking at this pattern, Blake, I'm assuming, again, especially if that CPI number comes in, as I've just described, that a move above 105.10 is very likely. And up to the 105.60, that's where that horizontal trend line is, 105.65, I think. So my guess is that CPI number is going to enable the dollar to have another pop to the upside. And, as I say, 106.71, which is where the rally from 100.62 to 104.97. If you add that to the 102.36, if the two rallies are equal, you get all the way up to 106.71. I don't think we're getting to 106.71. I do think that 105.65 is a more likely target. Again, I think the CPI will provide the boost.
And why do you think we won't make it as high as 106.70? Why are you so not motivated by the dollar strengthening?
Well, I'm respecting the upside and have been really since late December. That the idea that the Fed was going to cut rates 6 times was, in my mind, ridiculous. And that as that got peeled away, the dollar would rally. So again, could it get to 106.71? Yeah. But the higher probability is, in my mind, is 105.65. I think that's very likely. Now, if it breaks above that, hey, the more the dollar strengthens, I think that's negative for equities. And I do think it would be enough of a headwind to cause gold to have a pullback.
Well,
And that's my
not
guess.
much has caused gold to pull back.
No,
Actually, none
no,
at all. And I'm assuming that's your next chart.
maybe you tell
It
me. What did I
is.
say? I can't remember.
It
What do you know?
is.
There's actually some logic to all this. So the last week or two, I've been talking about, okay, we're moving higher, blah, blah, blah. Where you see that red one, my take was, oh, 1, 2, 3, 4, and that high for the red one took out the high for wave 3. After we got 5 waves up, we're going to pull back, and was fortunate to say, okay, sell 50% of the gold position that was recommended back on February 23rd. But I held on to half just in case, type of thing. And what wave 5 is doing what's called an extension. So it is also doing 1, 2, 3, 4, 5 to the upside. I think wave 5 will complete before the CPI report comes out on Wednesday. So I think there's a little bit more strength to come, Blake. And then my guess is a pullback towards wave 4. And this is the IAU ETF. It's easier for me to put labels on, and I wanted to add the red numerals, and so it was easier from a time standpoint to do it. But a pullback to where wave 4 was, which is, I guess, about March 20th, whatever the low was around there in gold, that would be one of the initial targets. I think there's a potential that gold could drop closer to $2,100. In other words, we had a breakout, go back and retest it. So my guess is that gold is going to peak based on this extension, no later than Tuesday.
Wow. All right. Well, we'll see. I know it's been strong and it's been unstoppable, really unstoppable.
Yeah.
All right.
And I think, there's geopolitical things happening
Sure.
around the world that are also feeding it, and I think probably helping the dollar a little bit too. Okay. So next up
Yep.
is
Treasuries.
Treasuries. All right. So since late December, my bias has been we're going to see Treasury yields go up. I think potentially that the 10-year is doing what's called a double zigzag, ABC up, X, and another ABC. So the two targets are 456, which is, if you look at the most recent low at 403.3 up to 434.8, you add 31 basis points to 418 and change, it comes in around 4.5. The initial move from 378 up to 435, if wave C is equal to A, that's where you get the 461. So my take here is, I think Treasury yields are going higher. It's just the question of, do they get up near 450 and stop, or do they push beyond that up towards the 461? Again, I think the CPI report has the potential of kind of sending a shockwave through the markets. Because everybody's still thinking, very few people are nuts enough to go through the detail
Yeah.
that I do, Blake. I mean, because everyone's like, well, we think inflation is still going to trend down. Well, maybe, but look at the numbers. The hurdle rates are going to get higher because the takeaway values from last year are shrinking. So in absolute terms, inflation has to come down. And given what's happened with energy, it's going to be tougher.
Are you really saying that just about an hour ago, Lori Logan said, I see meaningful risk to bringing inflation back to 2%. But in light of these risks, I believe it's much too soon to think about cutting interest rates. Are you saying that Lori Logan doesn't go through the details? Is that what you're actually saying, Jim?
No. I'm saying Wall Streeters. And your average person
I'm
doesn't,
just joking.
again, I heard a guy from Goldman Sachs who's really a bright guy talking about inflation working its way lower. And it's like, that may happen over the next 12 months, maybe, but when the CPI comes out for March, it's, I think, going to be, the annual rate's going to go from, it's going to increase by 0.2% and maybe 0.3. That will be headline catching, and
Well,
all of a
analysts
sudden,
are analysts are paid to re-estimate, and traders aren't. So yeah, there you go.
And again, there's that data point, and then just looking at the chart. You look at the 10-year, we got higher lows and higher highs.
Yeah.
That is a definition of an uptrend.
Yes.
So until that changes, one has to assume that we're seeing whatever the causes are, reasons for people to be a seller of Treasury bonds. And I think the pattern suggests that near term, we're going to see another move up in yields. And then it comes down, well, what could possibly cause that? The CPI.
Well, another thing that is making higher highs and higher lows is U.S. equities.
Yes.
So what do you make about this?
Well, here's the thing. They've been in an unbelievably calm, narrow channel. All right. So you got to, on my screen, my head is blocking the end of that chart. So maybe you can see the whole thing. All right. So the point is, yesterday's action was a key reversal, a 2-day key reversal. Most of the major averages, made higher highs than Tuesday and Wednesday, and then obviously lower lows and closed down. We broke below that channel. Maybe it means nothing. If that's the case, then the S&P should rally and get back above 52.25 or a little bit higher as you go out every day. That line is uptrending. So I think that break is meaningful. I think Treasury yields are going up. I think the CPI is going to, not be a good number. And that implies that breakdown out of that channel means something. And I think the most obvious place for the S&P to drop down toward is the 49.50 to 5,000 level. So that's my expectation.
So I'm gonna just put some words in your mouth at this point. Then I think that
it's okay. My wife does all the time.
a break below the 5,100 level, that support that 5,150 that I just drew there.
Yeah.
Line. A break below here would be bearish near term.
Well, I think breaking the red trend line is already bearish.
Okay.
Something changed.
Yeah.
Yesterday for whatever the cause. Now, again, maybe it's a one-day thing where you had various trading, computer-driven trading things generated sell signals and blah, blah, blah.
Yeah.
If that's the case, fine. It should recover and get back up into that channel very quickly. But I don't think that's going to happen. Could it go up and rally towards 52.10 to 52.20 to kind of test the underside of that line? That would be kind of common for it to do that. Again, I might be hanging my hat a little bit too much on that CPI report, Blake, but when I look at everything, it's like things are finally set up that people are paying attention to inflation. And, I think that will matter next week. So Friday, we will talk.
we will talk. Yes, on Friday.
I will either have a bunch of bruises on my face,
right? Like, Jim, you have a big black. What's that all about?
Yeah. That's like the CPI came in as expected, and no one cared.
Well, Jim, I applaud you for every week sitting with the Traders Summit crew and going through all this and keeping everybody on track and really explaining to them how this data breaks down and how to interpret it. And if you guys and gals enjoy this, make sure you give Jim a big thumbs up and jump down in the comments down below. And if you have something to say about how he's navigating through the markets, I'm sure he'd love to chat with you down there.
Yep. I look at those comments and I respond to everyone, Blake.
Yeah. And subscribe to this channel. If you hit that bell icon, you'll be notified every time Jim posts we get this new video posted, which is usually for a lot of people, good weekend, Saturday morning with a cup of coffee, listening and looking at your charts and really getting prepared for the following week. So Jim, I want to thank you for that, but how can people really thank you and follow your work?
Well, macrotides.com. Click on the subscribe button and you'll get a weekly technical review and a monthly Macro Tides issue. And if you tell me that you came to the website via these videos, you get a nice discount.
Awesome. Well, Jim, we appreciate you every week. I know I do, and I know I'm about ready to collapse. So I hope you enjoy your a great weekend there in California.
Thank you. You do the same, Blake.
All right. Bye-bye.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.